The fundamental relationship between Japanese rates and the yen has dramatically shifted. As long-term Japanese government bond yields rise sharply, US dollar to Japanese yen continues its climb, creating an unprecedented gap between these yields and the yen. Today, we explore why the Bank of Japan's yield caps are faltering and what this means for macro traders as they position for the next phase of the yen's structural decline. As we entered this quarter, the consensus was clear, with the Bank of Japan moving towards normalization and allowing JGB yields to rise. The yen was expected to stabilize. Most analysts anticipated a floor around the 150 mark. Positioning reflected this belief, with both retail and institutional investors expecting the narrowing spread between 10-year JGBs and US Treasuries to prompt a repatriation of Japanese capital. However, this anticipated support for the yen has utterly failed to materialize, leaving many investors caught off guard as the dollar-yen pair approaches the crucial 160 level. So, what changed? Despite the Bank of Japan's move to end its negative interest rate policy, the increase in yields isn't keeping pace with the upward pressure from the US Federal Reserve. While 10-year JGB yields have ticked upward, they're still constrained by the Bank of Japan's market presence. This has created an unprecedented disconnect. Just in the last 24 hours, long-term Japanese yields reached multi-year highs, yet US dollar to Japanese yen kept climbing. This signals that the market no longer sees marginal yield increases in Japan as a deterrent. The reality is that the real yield on the US dollar to Japanese yen carry trade is about 2.75%, which, while lower than the headline nominal spread of 4%, is still high enough to encourage yen shorting. This structural weakness is driven by the perception that Governor Kazuo Ueda's policies remain too lenient compared to global inflation trends. The path from higher yields to a stronger currency is blocked by doubts about the Bank of Japan's commitment to aggressive tightening. Reactions from Tokyo desks reflect a cautious outlook. A senior fellow at the Brookings Institution, along with a former Goldman Sachs strategist, points out that the current divergence is a direct result of ongoing yield caps. He notes that the yen's structural weakness stems from the Bank of Japan's policies being too loose compared to US rates. A macro analyst at StoneX adds that the yen's decline directly mirrors rising US Treasury yields, with little meaningful response from the Bank of Japan. Another investor cautions that interventions by the Ministry of Finance may lose effectiveness once the yen tests the 160 mark, indicating a potential capital flight phase. Sentiment is shifting on trading floors from when will the yen recover, to how high can US dollar to Japanese yen go before the system breaks. Why should a US dollar to Japanese yen trader care about JGB yields if the correlation is broken? Because the breakdown itself is a critical signal. When yields rise and the currency falls, it reflects a loss of confidence in the central bank's control. For Nikkei traders, this yen weakness presents a double-edged sword. It boosts repatriated earnings for exporters like Toyota, but it also raises input costs and fuels domestic inflation. We're seeing JGB yields driving bank stocks up as investors bet on improved net interest margins, but the overall equity market is getting jittery. If the Bank of Japan is forced into a drastic tightening to stabilize the currency, the resulting spike in funding costs could trigger a chaotic unwind of global carry trades, impacting everything from US tech stocks to emerging market debt. The Japanese financial press, including the Nikkei and local Reuters bureaus, is increasingly scrutinizing the failed policy transmission. While Western outlets often emphasize threats of intervention from the Ministry of Finance, local media are focusing on the political pressure mounting on Governor Ueda. There's rising concern in the national diet about bad inflation, price increases driven solely by currency depreciation, not wage growth. Reports suggest that the Ministry of Finance is frustrated, as their currency interventions are being countered by the Bank of Japan's ongoing bond buying. This disconnect between the ministry's currency stabilization goals and the Bank of Japan's yield capping actions is the key domestic narrative that international desks may be overlooking. Positioning data shows that leveraged accounts are heavily short the yen, despite the risks of intervention. Real money investors, like the Government Pension Investment Fund, are largely sitting on the sidelines regarding JGBs, as current yields don't provide enough risk premium considering the inflation outlook. Retail margin traders, known as Mrs. Watanabe, are selling into yen strength, believing that the trend for US dollar to Japanese yen will continue to rise. However, this extreme crowding in the short yen trade raises the risk of a significant short squeeze if the Bank of Japan surprises the market with even a slight hawkish shift in its next policy statement. Looking ahead, the crucial level to monitor is 160.20 in US dollar to Japanese yen. A decisive break above this could trigger a rush toward 165 as stop-loss orders activate. On the data front, keep a watchful eye on US CPI and Treasury auctions. If US yields continue to rise, the pressure on the Bank of Japan may become unbearable. Additionally, several speeches from Bank of Japan officials and Ministry of Finance representatives are scheduled in the next 48 hours. Traders should be alert for any shifts in language regarding decisive action, a term that often precedes actual interventions by the Ministry of Finance. Lastly, keep tabs on the 10-year JGB yield. If it surpasses 1.1%, the Bank of Japan might have to ramp up bond purchases, ironically leading to further yen weakness. In our hawkish scenario, the Bank of Japan unexpectedly abandons its remaining yield curve controls and signals a rate hike, with the yen weakening past 162. The implication? A violent yen rally, Nikkei sell-off, and a global risk-off move as carry trades unwind. In our dovish scenario, the Bank of Japan maintains its current course, while the Federal Reserve keeps rates high. Should US data remain robust, we could see US dollar to Japanese yen test 170, leading to substantial capital flight from Japanese assets. Finally, in our baseline scenario, the Bank of Japan implements incremental changes, deemed too little, too late. With moderate inflation, we expect a slow decline for the yen, keeping US dollar to Japanese yen in the 158 to 161 range while the Ministry of Finance conducts sporadic, ineffective interventions to manage volatility. Today's key takeaway is unmistakable. The relationship between Japanese yields and the currency is fractured, and the carry trade remains the dominant force. Remember these crucial levels: 160 in US dollar to Japanese yen and 1.1% in the 10-year JGB. Watch for any discrepancies between the Ministry of Finance and the Bank of Japan. If you found this brief insightful, be sure to subscribe to Tokyo Macro Daily for your morning market insights on what drives Japan. We'll catch you at the next open.